Welcome to the second podcast. This weekend I will be dealing with the US monthly indexes, of which I track 6. So let's start with the S&P 500, which had a November gain of just under 2.5%. And of course we broke a new historic high this Friday of 2079. Now that's 259 points above the mid-October low of 1820, which is around 14.2%. Pretty incredible gain. I mean, very few people would dare have suggested we were going to go to the 2100s, of course. Certainly when we were in the low 1800s, it all seemed like it was going to, unravel. But here we go again. The central bankers were wheeled out and off we went. Now, we're currently getting a yearly increase of around 300 points. So it's at the current rate of increase, it's not too far-fetched to assume that we're going to be around 2500s sometime next year. And if you start to believe that the ECB are going to somehow do a QE program despite the protest of the Germans, then with the European markets on an accelerated uptrend, that's going to really help America and Asia. It's going to be a self-sustaining feedback loop. What are we looking at next year in terms of really hyper upside? Clearly the next fib level is around 2138. Just about everyone knows that. After that, there isn't anything really until 3000, which of course seems like crazy talk, but I gotta think that 3000 now is a very valid level. 3000 S&P equates to a roughly 26,000 Dow, so keep that in mind. Okay, index number 2, Nasdaq Comp, which is seeing a monthly gain of 3.5% in November, and we're only just over 7% away from the March tech bubble high. A really big issue will be when you see a monthly close of 5200s. That should be enough to pretty much assume we're going to go to 6,000 to 7,000, which in itself is going to be highly suggestive of at least S&P 2700, if not 3000. So, tech market, it's on the way. Okay, the Dow, new high on Friday of 17,991. Nominal thresholds don't particularly interest me, except at the fact that the mainstream do get obsessive about it, so it's kind of unavoidable. It does look like 18,000 will be hit next week, and that's going to be something that a lot of people will focus on. But here's the really important thing: is if you think that 18 is going to be hit, which next week, then 20,000 isn't too far of a stretch to look to by next spring. And if you can assume 20,000 by the spring or early summer, given a little bit of a accelerated uptrend inspired by the Bank of Japan and more ECB printing, then the next fib level of the Dow would be around 26,000. Now I realize that's a long way up to hit by late 2015, but certainly if you give it a year and a half or so. Okay, next up, the Nyc Composite, which is stuck actually. It did manage to gain in November of around 1%, but currently it's stuck around 11,000 threshold. Upper Bollinger's offering 11,500s in the immediate term. That doesn't seem likely until at least January, maybe even February, but clearly the broader trend in the composite, representing the really broad market, is still bullish. Index 5, the Russell 2000, which, as I often call it, it's the second market leader. Still stuck under the double top of 1212/13, but it looks like it's going to put in a monthly close in the 1220s or higher. But that's probably not going to be this month. It'll more likely be February or March, because there's probably be at least some kind of retrace in whether it's this month or January. So. But once we do see the Russell in the 1220s, then you can look to 13, 14, even 1500s, which is going to equate to at least S&P 2500, if not considerably higher. as I've often said to a few traders over the last few months, the price action in the Russell this year is very similar to the action in the transports in 2012. And if you looked at what happened to the transports at the start of 2013, they broke out and they didn't look back. So, got to watch the Russell across the next month or two. Once we see a break above 1220, you're going to see the mainstream get hyper bullish, and then people will start chasing the Momo stocks again. All that nonsense will start up again, which has probably been one of the most notable aspects of this year. And you know, it's not the hysteria that we saw in 2012 or 13. Finally, transports. So we had a big gain in November of 5.1%, which is clearly due to the, in part due to the lower oil prices. Tranny looks like it's going to go to the 94, 9500s, whether it's late December or January. Clearly the 10,000 threshold, which is a huge psychological level, that's not going to happen until at least late January. My guess would actually be probably mid-February, early March for 10,000. It'll be interesting to see what kind of coverage that gets. Not specifically on the mainstream TV, but on the various blogs and general finance sites. But 10K, it looks like it's coming. So, taken as a collective, the broader market is unquestionably still in a bullish upward trend. The October low, marked by very clear spike floor candles on all indexes, has been confirmed by the November follow-through on all indexes. The fact that we're making new historic highs already this month is just kind of a bonus for the bulls. Okay, just a couple of other minor bits and pieces. Firstly, the jobs data today, 321,000 net gains with a headline rate of 5.8%, although I'd certainly contest the louder number. The gains were good, there's no question about that. If the market can string together, not the market, the economy can string together a couple of 300,000 plus gains, that's going to be significantly important. Now, one of my big predictions, I think the Fed are going to raise base rates at the March FOMC. I don't know what the FOMC date is because they're not been published yet for next year, but I would predict that the Fed's going to raise rates by 25 basis points, and that'll be a big market point. I realize a lot of people are looking for rates to stay basically zero for years, but I'm gotta think the Fed are gonna have to raise rates at least 2 or 3% in the current economic cycle. And of course, in the scheme of things, 2 or 3% is still damn close to zero. And yes, I'm aware of the derivatives and issues related to interest rate rises, but the economy is not going to crash because of a quarter of a point or even a few percentage points rates. So, not an issue, but I'm looking to March, and when they do raise rates, I think one of the big things will be the attention that's going to turn to financials. I'm going to be mentioning Bank of America probably a lot next year. It's definitely a stock I want to get involved in. Currently, the March high, I believe, is around 1791. If you can see Bank of America break 18 and then go to 20 and put a monthly close in above 20, frankly, there is open air to around 30 bucks, which of course is 50% higher, and in itself is indicative of S&P 2500, if not 3000, given 12 to 18 months. Okay, the only other thing to mention is low oil. Oil closed fractionally lower on the week, I believe. That's going to be good for earnings. There's no doubt now that oil is going to remain relatively low for many months to come. We're going to see a bounce at some point, but it'll be inconsequential and probably see another wave down after that. So that means Q4 earnings, and no question about it, Q1 earnings, which will be out in April, they're going to be pretty good, and you're going to see some good efficiency gains in certain sectors. Even the mining stocks, which I'm bearish on, they should have notable efficiency gains because of the lower fuel prices. fuel being a really high cost part of their cost base. So, you know, the broader market climbing, and there's hardly anything left of the year, is there? So even break back below 2000 now looks increasingly unlikely, which is, you know, thoroughly depressing. So no index shorts, no VIX longs, no point. Waste of time, waste of money. I ain't doing that until late 2015, early 2016, and there's, you know, we'll know nearer a time. It'll just be a matter of meddling on the long side next year. I'll be talking a lot more about the world indexes, and even I'll be thinking about going maybe long Russia via some ETF. I'm not sure which one yet. If the Russian market gets down to about 800, that'll be a really tempting level. But anyway, it's been a long week. It's late on a Friday, so hopefully some of that made sense. But I will be back on Monday, and have a good weekend and good night from London.